Good morning, hello, welcome along to How to Trade. It's good to see you for this early morning London stream. It's just gone 8 a.m. here in the UK, and Asia overnight is reasonably contained, I suspect. It's almost nearly the end of the week. It's been a great week in markets so far. Fantastic FOMC meeting yesterday with amazing coverage from Shane. I watched it all in real time as it was all happening. Really fascinating to see the way that gold traded, and also what happened to the stock market on the back of that. Now, I'm not going to go into too much detail around that today because we're going to do a broker workshop today. It's one of these things we need to keep on top of because there's new people that are joining the website every single day, every single week, and it's always surprising to me how so few people sort of like join the website and they're still not really figured out their brokerage end of what they're doing. They don't know what to do and they don't know how to actually sort of like figure out the best way of choosing a broker and which broker to go with. It's a very, very difficult thing because it's a very saturated market and there's lots of different things that you can do with the broker, and there's lots of different brokers that are there to offer you all kinds of different things. Some are good, some are bad, some are dodgy, some are really, really good actually. So there's a whole mix in there, but it is very, very daunting. So that is what we are going to go over this morning. We're going to go over the detail that surrounds all that. But just to quickly just tie up my own view on the Federal Reserve from last night, a lot of the journalists this morning are seeing it as being relatively not really a game-changing event. I actually think it was quite a big game changer because it started off pretty hawkish, as you would normally imagine, but we towards the end of it we started to get a dovish tone. And there was one particular sentence that I pulled out from the press conference which really, really caught my eye, and it was that he said towards the end, he said that we have come very far in this rate hiking cycle. And then he emphasized it again, very far. Very, very subtle, but that's different. That's dovish, because what he's basically signposting there is, okay, yeah, we may say higher for longer. Yeah, we'll keep the door open to more hikes if we want to. But that's for the first time in nearly 18 months since this all started that I've actually heard him say, okay, yeah, we've done a lot. Yeah, as in we've done a lot. There's probably not much more needs to be done now. That's probably it. That's a change. It's a very small, very subtle change, but it's a change. And Jerome Powell, out of all of them, has just maintained the same thing day after day, week after week, month after month. He's never deviated except what happened last night. So that's why I think we tended to get a slight hike in the equity markets, because dovish will be stocks up, dollar down. The dollar's not played quite as smooth a game, I don't think, but the basis of the stock market is starting to hold firm now, and then wanting to price that dovishness in. That could give us our Christmas rally. Everyone looks for a Santa rally towards the end of December, so that could potentially give us that. So a really, really fascinating take on it, and great coverage there by Shane as well. Now, in the mix this morning, Connor is away. He's on leave today and tomorrow, so it is just me this morning. So we'll run through our brokerage workshop, and then Shane will come up a little bit later on in the US session to cover the state of the labour market with what's happening with ADP and JOLTS, and that will tee up very nicely for what we're going to do tomorrow, which will be the non-farm payroll live. Okay, so let us jump in. If you are new to the website, welcome along. It's really, really good to have you here. Now, one of the things that we are very privileged to get to do is to get access to markets in the way that we do these days. Most people think that it's a given, but it's not been a given for a very long time. And the advent of technology and the internet has really, really made a huge difference in the way that the general public and the retail trader gets access to this stuff. You rewind 20, 30 years, you wouldn't be able to trade the things that you're trading the way that you're trading them. So it's really a testament to technology and the way that the brokerage industry has developed and opened its doors that gives you that ability to access the markets. So a lot of people when you're learning how to trade, a lot of people will come across a lot of stuff online on Reddit forums and stuff, how really, really, dumping on the brokerage industry, which to a large degree, there are some bad actors in there for sure, but it's quite without the brokerage industry, you wouldn't be able to get access to it. So it's actually quite a good thing, because you do need that middleman to stand there and allow you, because if you wanted to sell euro dollar today and you didn't have a broker, what could you do? All you could really do is physically exchange your own money in your bank account, either at the bank or maybe at the post office or a travel agent or an airport, bureau de change or something like that. That's it. You have no other route of getting into the foreign exchange market. So the brokerage industry allows you access. So that in itself is a fantastic thing. We're going to look at 5 key areas when you are deciding to open a brokerage account for the first time. We're going to start with leverage, margin, swaps, and spreads, and just briefly explain what they are. Then look at market access. We'll then look at the very, very important area of customer support that you should always consider. Any rules and regulations, you should always go with a regulated broker. That's always a good thing. And then also order processing as well, how your order is actually handled by the broker, because this is the bit where it starts to get very confusing for most people. Looks like a lot there, but it's not that complicated once you've been through the basics. You understand some of the simplicity, some of the reasons why some of these things are in place, and then you've started to have a practice yourself. And like anything in life, you can't really beat experience. And it's one of these things. It might feel a little bit scary at first, but once you get your toe in the water, you work with a good broker, you'll start to realize that it's actually not too bad at all. Now, we had a question in overnight, and that question was specifically about leverage as well. So I'm going to touch on that this morning as well. I'm going to tie up that and clarify exactly what that is. So let's just run through the basics. Let's start at the top. Leverage and margin. Now, how do we think about this? Now, when we trade, we always trade with borrowed money. And the easiest way to really think about that is leverage has an impact on your profit and loss, because essentially leverage is what is a fixed cost within your little trading business. So if you have a lump of currency, that's fixed and it doesn't move. The exchange rates that move around then impact your profit and loss. So that fixed, in any business, leverage is a fixed cost, the cost of doing business. So it's no different in trading as well. Leverage and margin performs exactly the same function. It's basically borrowing money. Yeah. So just like when you want to buy an apartment or you want to buy a house, you get a mortgage. What you are doing is you're borrowing on margin. Essentially, you're using leverage to get where you want to go. The money for the house is not yours, but you have to put a deposit in. It's exactly the same principle. You put a deposit in down on the house, and then the bank comes in and they put the rest in, whether it's 5%, 10%, whatever that is, and then you borrow that. You know, if your apartment is 100 grand, you put your 10 grand in, the bank puts in 90, and now when the house prices move up and down, you're getting the price benefit not on the 10 grand, but on the whole 100. It's exactly the same in trading. That's exactly what we do. There's a very, very key important point though to mention about margin and leverage, and that is margin is dictated by your broker. Leverage is something you choose. So your deposit is dictated by the broker, the amount that they require for you to have on deposit to get access to a certain level of funds. That's the same as the bank saying, okay, Mr. Quinn, if you want to borrow 100 grand for the purchase of that apartment, you need to put 10% in, and we won't accept any less than a 10% deposit. That is stipulated by the broker. Yeah, that's really important. The amount of leverage, well, that's up to me. Now, a broker will offer me a certain amount of leverage in the same way that the bank will say, okay, well, you make a good salary, Mr. Quinn. We'll lend you up to £300,000 if you like. And I go, well, yeah, that's great. Thank you very much. But I only really want this apartment and it costs 100. So I get access to all the extra borrowing, but I don't necessarily have to use it. That's a really key important point that explains the difference between margin and leverage. Margin is dictated to you by the broker, and they can alter that as well. And they do when things get tough and markets really go haywire. You'll see, particularly in futures markets, you'll see that the margin requirements go up pretty steeply, and that means that you can basically leverage yourself to a much smaller degree. The leverage, though, I get to choose that. Now, a good sense of perspective, and I have had this this question quite a few times actually this year, and that is what is the right amount of leverage to use? How do you know? Well, you're going to need to experiment to a certain degree, but you always need to set a sense of perspective. So in the UK, the regulators have come in the last few years, and they've put a stamp on how much money people could borrow, basically in terms of leverage for brokerages, and they capped that for retail customers at 30 to 1. But in some brokers in different jurisdictions around the world will offer you you huge amounts of leverage. Obviously, you quite commonly now you'll see leverage of up to 1,000 to 1. So whatever you put in your account, you can borrow 1,000 times that amount of money to trade with, which is just phenomenal. It allows you to open huge, great big positions. Now, that's great in the sense that, you know, if you're on the right side of the market, you'll make a lot of money very, very quickly. But of course, you'll just blow yourself up out of the water if it moves against you. So leverage is a double-edged sword, and learning to use leverage takes a number of years. It's not that particularly easy to do. Just to give you the clear sense of perspective of what leverage can do, Lehman Brothers, most people will have heard of Lehman Brothers, the the investment bank that went bankrupt in 2007, 2008. They were bankrupted by the amount of leverage that they had on their books. The amount of leverage that Lehman Brothers had exposure to the housing market was 30 to 1. Which is the lowest amount here. So that shows you how powerful leverage is. Yeah, it really is. Now you couple 1,000 to 1 leverage with people that don't really know what they're doing, trading on fast time frames, trading the DAX open on a 5-minute time frame. Good luck. You know, that's why it's so complicated. Now, we had a question overnight asking, well, I'll read it out. It said, "Hello, Nick. I'm trying to find the effect of leverage in risk management, but I can't find a formula including it. I mean, if you decide to risk 1% of your account on a currency pair with a given stop loss, account size, and an account currency, what does leverage have to do with it? All formulas return the lot size and that's it. What am I missing?" Okay, well, let's explain that in little details. All you really need to do is get a sort of like a context of understanding what you're doing. The market is the market. The amount of leverage that you employ really is up to you to decide, but the amount of risk you take in monetary terms, that's also what you decide to do. So what you've got there is you've got some fixed elements and some moving elements. Number one, you've got your risk. That's fixed. You decide if you're 1% at risk. That's a monetary term in terms of your equity in your account. Okay, that's fine. You've also got the market distance of however that moves. That's not something you can control. So whatever that is. So if you employ a lot of leverage on your account, the distance that you can endure in a swing against you starts to decrease. And that means you then have to it's like a sort of weird Rubik's Cube, 3-dimensional Rubik's Cube. You have to somehow align the volatility of the market with the amount of leverage you want to employ based on how much you want to risk. Now, the easiest way to try and think about that in a real world analogy, and I hope you love my artistic drawing skills, is to think of it like this. So imagine we've got a car, and we've got your foot is on the accelerator pedal, or the gas pedal as they call it in the United States. Your foot is on the gas, okay, and your car is traveling down the road, okay? So as your car's moving down the road, if you depress the pedal by a certain amount, let's say that distance there where the little red line is, let's say that equals, I don't know, 2 inches, yeah? That distance that you can depress the accelerator pedal in the car does not change. It's always the same thing. That's our market distance. That's the market distance there that's being moved there. Now, as you press that pedal down there, what you do is you put power into the engine, and that engine then moves you down the road, yeah? And it will, and however much power you put into the engine, it will move you down the road a certain distance. Now, if we're in first gear and you depress that pedal by 2 inches, you're going to get a certain amount of power in the engine that's going to deliver you a certain amount of distance down the road. So say, for example, you just stay in first gear, that 2 inches of depression in the gas pedal is going to give you 200, in fact, let me use my little laser pen, it's going to give you 200 feet of distance down the road. That's all you're going to get from it. And then there's going to be no more power left, and the car will just roll to a standstill. Now, say, for example, we're in third gear or fourth gear. That 2 inches of distance here that we depressed, we've not changed the amount of distance that our foot traveled, yeah, that the foot traveled on the pedal, yeah, that's not changed, but the gearing is different in the car, yeah, and that equals more power in the engine, yeah. I mean, I'm not a mechanic, obviously, so you know my engineering skills when it comes to gearing and that kind of thing is very, very limited. So I'm just trying to think of an easy way to explain it. But the point is that the gearing makes the difference in the distance that you travel. So it's the same thing. You have elements within this equation that are fixed, and you have elements within this equation which are changeable. And then the resulting impact of those changes equals a different result. That's the way to think about it. So this is like saying we've got our market distance, which is always fixed. The first gear here, that will be an example of low leverage. Yeah. So that's basically saying that we've not got much impact on our account. And then if we move up to a different gear, we will get much more distance out of that, and you'll get that will be an example of how we would describe high leverage. So you're getting more distance. Yeah. Now the distance basically equals your profit. Yeah. So if the market travels to that particular distance there, and it's only going to travel 200 pips within the course of the day, but if you have a low amount of gearing here, if you have a low amount of leverage, you're not going to make much money. The swing on your account is not going to be very much. If you then go into a high gear, that 200 pips in the market will equal a lot more distance on your account. So maybe you'll surge $1,000 or something like that because of the gearing of your car. Yeah. Now, if you now add into that a 1% risk, that 1% risk is detached from this equation because it just governs this distance here. Yeah. So it could be that this that your 1% risk chops off that amount of distance there. So the speed at which you're going to get there is much, much quicker. You see what I mean? That's the way to think about it. It's not that complicated when you start to break it down. So if you remember nothing else, remember this. If you fix your risk at 1%, which the 1% risk tolerance is obviously a very important measurement that professional hedge funds and traders and banks, and it's industry standard, 1%, 2%, that kind of thing. If you're going to use that and you're going to use it with a higher amount of leverage, all that's really happening is you're shortening your distance in the market. Your stop loss is going to have to be tighter. So there's a sort of like weird balancing act that needs to go on. If you're going to risk that 1% and that's set in stone, that's a good thing. What you're going to need to do is you're going to need to adjust your leverage to cater for the volatility that we've got in the market. That's basically it. That's all you need to know. Okay? Gosh. We're like nearly halfway in already, and I've only covered like one tiny aspect. So that's basically that, basically. When it comes to understanding spreads are fixed and they're also floating as well. So the spread is the difference between the price that I can buy at and the price that I can sell at. That's all that basically is. Some brokers will offer you a spread that moves like that, goes up and down, and that's how they make their business. That's how they manage their risk and all that kind of thing. And other brokers will offer you a very fixed amount of distance. That's how that basically works. Also, as well, if we are using a retail forex account on an MT4 platform, and pretty much everybody here will be doing that, then you've always got to consider as well the overnight rates as well. And they are, if you head over to the, let's quickly show you where that is. You will see here. Let me just move all this over. If I go to my MT4 here, you can see that every position, every market here, if you right click, you'll be able to go down to specification. If you hit that there, you'll see your swap type there in points, and you'll see it there, long and short there. So if you hold that the euro against the Canadian dollar open, and you hold it over the end of the day, if you hold it over the end of the day, then from the end of the US session into the Asia session, your broker will either deposit or take money from your account. And that is like an extra payment or an extra refund as well, depending on which way round you're actually doing it. So you can see here that on the long side, you get minus 6.89. And on the short side, you actually get paid. So it's like you get paid. And that also, ties directly into the interest rate differentials between different central banks. So if you look specifically at the dollar against the yen, obviously the Japanese have negative rates, and that's why we've got the price of it the way it is. You'll see there. So look at that there. Massive difference. So if you're on the long side, you get paid that interest rate differential there, but look how expensive it is. On the long side. But if you then go short, you're going against you're going against that. You're paying the American interest rate differential, and that costs minus 30.82. However, that is divided. It looks like that's divided into points. So, but the point is if you are a long-term trader like me, that is a real factor in your trading decisions. Now, broker to broker, this will always vary. They will always vary it. So that's something that you should find out from the broker that you're going to work with, whether you are happy to accept whatever their swap rates are. Interesting thing as well, these are the important things in trading that most people don't consider, and you can always know it's really important in retail trading because it's always not front of the shop. It's always hidden in the background, the important stuff, and swap rates is definitely one of those things. Okay, so let's go back to the presentation. So let's now move it on and talk about market access. So, like I said right at the very beginning, these markets obviously been around a long time, but your access, the retail traders' access to markets has not been around that long. Certainly within the last sort of 20, 30 years, that's been about it. And slowly the industry has started to mushroom and started to grow and all that kind of thing. So the fact that we actually get access these days is pretty remarkable. And you are fully in control, and a lot of it is automated. The onboarding is automated. Your the uploading of your documents, and you got to basically say who you are and prove who you are and all that kind of thing. And the flow of your money in and out of the account is pretty much instantaneous these days as well. So your ability to get involved in these markets is very, very, very smooth and very, very easy. It's not difficult to do, and of course a lot of it is accessible on your mobile these days as well. As long as you've got an internet connection, you are good to go. So you're unlikely to have a problem looking for any market that you are interested in, and it doesn't really matter whether it's currencies or gold or oil or natural gas or Tesla or Apple or any of these sort of different types of markets that retail traders like. You're unlikely to have a problem. Most retail traders these days, even on MT4, will offer you a whole boatload of different markets to choose from. When I first started, it was just Forex. That's all you could get in MT4. It was just a selection of Forex pairs. But it's completely different now. It's not. Hang on 1 second. Bear with me 1 second. Okay, that's better. So you're unlikely to have any problems trying to gain any access to any markets, and that's really the way that it works these days. For most people on MT4, they'll be able to get access to currencies very easily. They'll be able to get access to the stock markets and the indices and all that type of thing. A lot of brokers now will also offer crypto products, cryptocurrencies, as well as a result of the demand for cryptocurrencies too. So you're always going to be able to get a good selection. Just bear in mind of what we are trading when we are trading in MT4. We are trading contracts for difference. It's a particular type of trading vehicle for everyone to use. It's not so for example, in cryptocurrencies, you're not actually buying Bitcoin, you're not actually buying Solana or Ethereum or any of those coins themselves. What you're really doing is you're putting your account across the price. That's basically all that you are doing. There's no real asset behind it. So that's an important point. So if you are just looking to trade the market, that's absolutely fine. And this is what is one of the ways that when we look at the different markets, there's different ways that you can get involved in it. It's not that there's very, very little barrier these days. So just bear that in mind as well. So let's move it on now, and let's talk about this all-important area of customer support as well. Customer support is often overlooked, and anyone that's choosing a broker should not overlook the customer support. It's really, really, really super important, because most things in life, everything being automated is great and wonderful when we're all happy and we're putting money in and everything's working and we just want to download the stuff and we want to get going. But when something goes wrong, you want help, and you want that help, and you want it there and then. And as a result of that, you more than likely you want to talk to a human being. Yeah, so that's an important consideration whenever you're selecting a broker. Interact with the customer support people, find out how they work, what they do, what they can offer you and what they can't offer you. How quickly do they answer your question when you're talking to them? Because if they get ages to get back to you and then something's going wrong on your account, are they going to take a long time to get back to you when it really counts? Yeah, when you really need some help. That kind of thing is an important factor as well. Also as well, remember the customer support people is they're people too. Yeah, so if you're nice to people, they'll be nice back to you. You know, and this is an industry where we do get lots of people that get angry if they lose money and all that kind of thing. So you just bear in mind that you will get a better level of service if you treat people the way that you want to be treated. That's a really important point. Also, as well, with any broker that you decide to work with as well, test the processes, test the withdrawal and the deposit processes as well. So if you really want to take it seriously, don't send a lot of money to a broker straight away. If you've never done it before, send a small amount and then don't trade it, and then wait a week and then do a withdrawal. And what you're doing there is you're testing every bit of the chain. That's what you're doing. You're testing every single bit of the process, and that is something that can really make a difference, because there may be things that you've not considered. Things like, are there any withdrawal fees? Are there any delays in which the deposits hit your account? That might not be completely obvious when you're sort of looking at the website and you're looking to sort of just get involved. Maybe it's buried somewhere in the terms and conditions and you hadn't even read that far. I mean, you know, people don't read terms and conditions, do they? You know, so just bear that in mind as well. Test all of that stuff. It's really important to do. And now, when I first started trading, there were withdrawal fees on everything. Everything cost a lot of money to get money out of the system. These days, though, no, most of them don't ask for any withdrawal fee at all. If it's a bank transaction, then yes, they will sometimes. But even then, those charges are now much smaller than they used to be. So it's an industry that is really making that barrier to entry really low. And that's you'll find that most brokers work like that. So if you're working with a broker now that charges you a fortune to get your money out, then you've got a very legitimate reason to switch. A really strong reason to actually switch. It's not something that you should have to worry about too much, that's for sure. Okay, so moving that on as well. Oops, bear in mind. Next one. Let's move on to this one now. Now, this is regulation. Rules and regulations. What do they mean, and how do we need to adhere to them? Well, it's not really something that you need to do. This is really for the brokerage side of the industry, because there's a lot of there are not a lot, but there used to be a lot of bad actors in the brokerage industry, you know, scams, and you always get the same. You always get one or two these days, and it's an industry that's always gonna attract that kind of element to a certain degree. But for the most part these days, pretty much a lot of the really big brokers anyway, they're they're almost like institutions. I mean, they really do run a very legitimate business that adheres to all of the ethical, you know, and moral codes of conduct that anybody would want to adhere to in a civilized society. And one of the things that helps regulate that is the regulatory bodies that are set up in each of the different countries that are there to govern how financial services are used and interacted with. So you've got here a list of websites of some of the really big guns. You've got the FCA here in the UK, the SEC in the United States, along with the CFTC as well, ASIC in Australia, and then you also got the FSA in Japan, and then CISIC in Cyprus. Cyprus was a relatively new jurisdiction for retail trading. There's a lot of the retail brokerage industry is in Limassol in Cyprus. It had a bit of a kind of like a not very good image right at the very beginning, but it ain't now. I mean, it's really like bustling, you know, and it's a real legitimate hub for brokerages. So yeah, it's a good thing. And the regulators come along and they put all of these rules down and all these things that people have to adhere to. They put that all in place, and then the brokers have to adhere to that. So if you are selecting a broker, you do need to find out from that broker who they are regulated with. And some of them will have multiple regulations because they'll operate in jurisdictions. Some of them won't. But just because they are not regulated, it doesn't also necessarily mean it's a scam. And the reason why is that anyone that wants to set up a brokerage themselves has to have a reasonable amount of capital to do so. It's a very expensive process to actually do. If you want to become regulated by one of these guys, it costs millions and it takes a long time. So it's a very expensive process. So any broker that has that sticker of approval from a government is definitely okay to deal with, but you also know they've had to jump through an awful lot of hurdles to get there. But as a consequence of that, also as well, you may get a fantastic deal from a broker that isn't one of these regulated, or isn't regulated by any of these big guys. But that doesn't necessarily mean to say that they are a scammer. It just may be that they don't have much money, and they've not been around long enough to actually go for those bigger regulation, bigger regulatory seals of approval. So just bear that in mind. But as a rule of thumb, if you're new, then always go with a regulated broker. That makes a lot of sense. There's a few reasons for that as well. One of the things that a lot of regulators will do is they'll have to adhere to a whole boatload of different things, and that will vary from jurisdiction to jurisdiction, but you'll find that a lot of them will be the same. So one of the things will be what's called a net capital rule, and that means that the brokerage themselves has to maintain a certain amount of money within the business itself at any one point in time to protect the clients. So what that means is it means that there has to be money in the bank accounts just in case something goes wrong. Yeah, so you can't have, the customer deposits are coming in and then the marketing department put their hand in the till and say, thank you very much, we're going to go and spend some money on a lot of adverts or that kind of thing. You can't have that. The broker has to maintain a certain basic level of liquidity within the company itself. So that's something that you're always going to get with most regulations. Also, segregated client funds. So the idea is that you deposit your money in your account and that goes into a pool of money with everybody else's money, but it's not in the broker's account for them to just do what they want with. It's in a segregated account which is designated purely for transactions based on on people buying and selling in the market. You won't see transactions on that bank account that are anything to do with other than deposits and withdrawals from customers. You're not going to see expense accounts claims being taken out of there as well, and all that kind of thing, or wages for the staff or anything like that. You've got to always bear that in mind. So your client funds need to be segregated in that, and as well is a form of safety too. Also as well in the UK, which is a good reason for working for a UK regulated broker if you're able to, is that in the UK there is a certain level of deposit insurance as well. You get that in bank accounts. I think it's like £80,000 now that you're guaranteed to get back from the government in any banking current account. But from a brokerage point of view, there is a certain level of insurance protection that you get as a consumer if you deposit money in a retail brokerage account from an insurance point of view, and that's backed by the government as well. So you get an extra layer of protection in there as well. So these days, occasionally you're going to get a brokerage that's going to go wrong, but it doesn't happen that often. And it's for the most part, it's a pretty well run industry now. Certainly a lot better than it used to be. Okay. Now, let's talk about the last section here, which is order processing. And this is the bit that really confuses people. And it shouldn't do, because once you understand the basics of this, you really get the idea of what is how you want to work. Now, there's different ways when you're buying and selling in the market. There's different ways that you can do that transaction. You're hitting a mouse button, but there's a whole chain of things that are happening between you and the transaction taking place. Now, when you have when you buy and sell on MT4, you are creating an order. You are telling your broker what you want to do. Your broker does not. Money is in your account, but your broker is not analyzing the markets. It doesn't know how you think. It doesn't know what you want it to do, what you want them to do, unless you actually tell them what you want them to do. So, as a consequence of that, what we need to do is we need to have a particular way of stipulating how orders are dealt with. And then your broker knows exactly how you want to work. And these are the three models, the main models, which to this day are the most popular types of ways that orders are processed in the market. They are ECN, which stands for Electronic Communications Network, a dealing desk model, and STP-NDD, which stands for straight through processing, no dealing desk. So it's the opposite of that dealing desk. That's kind of it. I'm not saying that there are other ways of doing this. There possibly are. But from a retail perspective, this is probably going to be how you're going to actually be buying and selling in the market. So let's go through them in detail. Let's start with the ECN. Now, this is immensely popular, particularly by people that have been around a while and maybe they're aggressive scalpers and that kind of thing, and say, well, you know, you've got to use an ECN because it's the best way of doing things. Yeah, it's true. It has its advantages, but there are also some disadvantages as well. Now, what an ECN does is it allows the market participants to trade with each other over a network. That means that the ECN basically matches orders together. So you want to buy the euro dollar at a particular price at a certain quantity. That gets fed through to a network that's got lots of other people on it as well. And then the orders are then matched by the network. And what that means as well is it means that when you're buying and selling from another entity, you are essentially anonymous. They don't know who you are and you don't know who they are. It could be a bank. It could be another retail trader. It could be another broker. You got literally no idea. And your broker just basically passes that straight through to the network. What you're going to get from that is you're going to get very, very fast execution, and you're going to get a very, very tight spread because it's a real competition for pricing in an ECN. So you get very, very tight spreads and you get very, very fast execution, and that's why you'll see a lot of people that are scalpers will say this is the way to trade because they get in and out like that very, very quickly. So when you want to get out, you hit the button and you are out. When you want to get in, you hit the button and you are in, and that is great because they feel that you've got a very smooth, fluid way of buying and selling very quickly in the market. Okay, that's good. It also means that you can have your orders very close to the market as well. It's the most competitive form of market access that we have as retail traders. But there is a problem, and the problem is that your broker is taking a commission because they've got to make money from it somewhere down the road. So they'll charge you a commission, but they're just standing at the side and they're just connecting you to it. So they are essentially a real middleman there, and they're just passing your order through. Now, that's great for you because you may have a competitive commission and you get good execution, but the risk is a lot higher because if something goes wrong, if something like kicks off in the market, if we have another war breakout or the war escalates or something like that, or the Swiss National Bank decide to change something drastic in the Swiss franc, or something like that on that comes along that no one was expecting, your broker can do nothing for you. And people can blow up and they can lose their accounts, and it's basically because they are at the mercy of the network. So you are at the mercy of the dark pool of other entities that are in this electronic communications network. You don't know what they're doing, and they can do whatever they like. So the risk is completely on your shoulders. So when people are trading on an ECN and they really they get a car crash, so your stops could basically get filled at the most horrendous prices, all that kind of thing. There's nothing that your broker can do. So if you're on an ECN and something goes wrong, you contact your broker, they just basically say, sorry, mate, nothing to do with me. You wanted to trade on an ECN. You want the upside, but you're not prepared to take the risk. Yeah, so just bear in mind that these things are great on one side, but they also carry risks as well. So always bear that in mind if something goes wrong. The black swan event, basically. But black swans do occur. They do. Let's move it on to a dealing desk. Now, this is the model that gets the most hate, I think, on the internet. Most people don't like a dealing desk model. But actually, it's okay. It's okay if you're just beginning and just getting started because the broker is there to help you. The only downside is the broker is essentially your counterparty. So you are taking a view on a currency and you're saying that you are right and your broker's taking the opposite side, and the broker will say, well, you're wrong. So when you lose, the broker wins. That's how it is. So it's a kind of like a real binary relationship. Now, most retail brokers will offer this. I've never seen a retail broker that doesn't offer this. This is the base. This is the benchmark of how retail trading was developed when it was developed. You know, when quotes built MT4 and that kind of thing. It was all kind of dealing desk models. They act as a market maker, so that means that they offer a two-way passive price, a price that you can buy at and a price that you can sell at any point in time. That's what a market maker does, and they can set their prices however they want. As long as they offer you a route in and a route out, they have done their job. But that means that they're in control of all of that. Yeah, so if they want to charge you more, they can. But that's obviously an arms race, a race to the bottom, in terms of then some brokers will offer better dealing desk models than others, and then it's up to you to choose who you want to work with. Now, a dealing desk, what they'll do is that they will be the opposite counterparty to your trade, and what they'll do is that they then go away and they'll hedge their overall exposure somewhere else in the market. You've got no control over that, but people will see that way of working is essentially a conflict of interest, because the broker's got a vested interest for you to lose money, that type of thing. So it has a negative stigma attached to it. However, it does have some advantages too. And it's a good way of getting started. I wouldn't use a dealing desk model now. I use an ECN, but I wouldn't use a dealing desk. But I've been doing it 15 years. But if you're new and just getting started, it's not a bad way of doing it. It really, really isn't. And the key advantages are 9 times out of 10, you'll get a fixed cost spread in your transactions. So you'll always know where you're up to. You'll always know the cost implications of what you're doing in your buying and selling. It will always stay the same. If something then does kick off in the market that is unexpected, your broker will protect you, because they'll have all of their risk mechanisms in the background to clamp down on the market and basically protect your account. That is a good thing to have in your favor, particularly if you're new and you're not expecting something and maybe you forgot to put your stop loss on or something like that. There'll be some protection in there from your broker. You'll know who your counterparty is. You don't know who your counterparty is in an ECN, so that can be useful to know too. You'll always be offered a relatively simple platform. Now we work with MT4 all the time, but some brokers have their own white label built platforms, and they'll build them in a way that makes it very easy when you're new just to start getting involved, because people, they do want to get involved. They don't want to sit there and learn a theoretical book on the different technology and how orders work. They want to get involved. So what those brokers will do for the dealing desk clients is they'll offer them a very simple platform where you got simple buttons, simple way of getting involved. Now, when you get a bit more sophisticated, that's not going to be good forever, obviously. But at the beginning, it's perfect. It's absolutely perfect. So there's nothing wrong with that. It's absolutely fine. Also, as well, broker dealing desk models will also usually offer a lot of incentives as well. They'll maybe double your deposit. They will give you certain incentives, that kind of thing, giveaways and all sorts of other stuff. And that, it just makes it a bit nicer, yeah. So your experience of getting in there is a lot easier to do. And obviously they'll help you a little bit more potentially too as well, yeah. So they'll maybe help you on the education front as well, all that type of thing. Easier to answer questions for you and all that type of stuff. You get some of the other models where you get less help and support. Now, it's not going to suit you forever, but once you've been doing it a few years, you can gravitate away from it and then start branching out on your own and take a bit more ownership of your trading journey yourself. So the dealing desk model is not a car crash. It's not a bad thing. It does have its place and it does have its uses. The final one is the STP-NDD, which is the straight through processing, no dealing desk. And this is basically where the broker has to get its prices from somewhere. They have to have a liquidity provider. It's usually an investment bank or some sort of intermediary that connects investment banks to a whole series of brokerages, and they supply liquidity. So the leverage, the borrowed money that you're using has to come from somewhere. It's usually from an investment bank, and that brokerage has that liquidity provider, so they connect you with that liquidity provider. That's how it works. So they are a middleman, and they take your order and they pass it directly to their liquidity provider. So there's no dealing desk, but they are connecting you directly to the person that they are doing business with. So you always know that your trade is being executed by the same entity at every single every single transaction. So it means that the forex broker, they act as a middleman. You'll get floating spreads as a result. So sometimes you'll get better prices than others, all of that type of thing. And it will not be matched by the broker themselves. They will not match you with a client. That will all be done by the people that the broker does business business with. Now, you can ask the question, who is your liquidity provider? They may tell you, they may not do. I think a lot of them, they kind of, well, that's nothing to do with you. We offer you an STP model, and that's great. And it's up to you whether you decide to actually work with that or not. Maybe so they'll tell you, maybe they won't. I don't know. I've never actually asked the question, but you can certainly try. Is that better or worse than any of the others? No, not really. The only thing that happens with this type of thing, with an STP, is sometimes your spread will be floating, so that can be a good or a bad thing. But what can also happen is there can be a slight delay in execution. So sometimes if you want to get out of a position quickly, there'll be a delay because the order goes from there to the broker, gets passed on to the liquidity provider. They match the order however they want to match it, and then it comes back the chain, and that actually creates a little delay in execution. That is irritating. I don't particularly love that, if I'm being honest with you, but I only don't really like it if I'm on a 5-minute chart and you're scalping around. It gets irritating. But if you're just trading long term, it's not really much of an issue at all, because you sort of generally want to get in an area and generally want to get out. So it's not too bad, but it's not as a precise way of working as some of the others. So are there advantages to that? Yeah, I suppose so. It's fine. Your counterparty is not directly a broker, so that in itself is a good thing. So it just depends what you want. So most people, the route that you would do is maybe you would start with a dealing desk, you'd move on to an STP, and then you'll end up in an ECN. That's potentially maybe the route that you would take. So to sum it all up, fear of the unknown, that's really the biggest thing. That's really the biggest problem that most people have with choosing a broker for the first time. And you shouldn't be, really, because it does look and feel like a bank, but it isn't. And the reason it feels like a bank is because we push money over the internet, huge amounts of money. And, well, not always huge amounts of money, but we do. It feels like a bank transaction, but it's not. The best thing to do to overcome those fears is basically to ask questions. Interact with the customer services. That's the first thing that you should do. And get a sense of all of those things that I talked about when we talked about customer services. Download the demo platforms and play around with them. What platforms do they offer? Every retail broker should offer MT4. C-Trader is another really popular one as well. Download them, play around with them, figure out what they do. Do they offer anything else? Some of them, for premium customers, will offer them a really high-end platform as well, a third-party one. That happens too. Some of them will offer connectivity with TradingView. Some people like to trade through TradingView as well. It's obviously very popular for charting. Some brokers will offer you that connectivity with TradingView. You do get what you pay for in platforms. Most MT4 customers, it's always free. Obviously, the platform's free, but there's a reason it's free. Yeah, if you decide to pay for a platform as well, a monthly subscription, something like that, you'll get a lot more for your money, and it will be a lot better. So just bear that in mind. And some brokers will offer deals with like multi-charts, or I don't know, TradeStation, or Ninja Trader used to offer things with FXCM, and there's lots of different ones. So it's a really, really super important thing just to remember. You do have options. You're not just you're not just stuck on MT4. You don't have to be an MT4 trader. Remember, brokers are interested in turnover and volume. That is their business. So this whole notion that the broker is just there to watch you lose money, or to hope that you lose money, it's a little bit binary, really. It's not quite as black and white as that. The broker is interested in happy clients that are successful, making themselves a bit of money, learning, creating transactional volume for their business, frequently trading, and overall having a positive experience. You make a bit, you lose a bit, you make a bit, lose a bit. That is what the broker is looking for in an ideal client. And that means they need someone who is there, not being aggressive, not over leveraging, taking it seriously, learning, and is there for a long period of time. That's an ideal customer for a broker. So the whole notion that the broker just wants you to lose all your money really quickly, it's not really, really true. You want customer, because as soon as someone blows up an account and they disappear, the broker has to spend an awful lot of money going to find another customer. So the broker needs to there's actually an industry cost of how much it costs overall through Google Ads and social media and stuff to try and the cost of how much customer, because you obviously you have like 1,000 people watch your video, and then maybe 100 people click on your platform, and then 10 people will download a platform, 2 people will register and send their emails, and then 1 person will open an account. Yeah, so that if you then sort of spend advertising money on all that type of thing, there's a cost of acquisition per customer. How much does that cost? It's really, really expensive. It's like well over $1,000 or something like that, I think, for one new customer. So the broker doesn't actually want customers to keep dropping off. They want customers that are here and they're learning, and they're not blowing up, and they're not really sort of like having a lot of problems. They want them to be successful, and they want them to be around a long time. That is the ideal customer. So just bear that in mind as well. So that's why they're interested in turnover of trading turnover, and also volume of business as well, because it's how they make their money. Test the water with the deposits and withdrawals. We touched on that already. Well, that's a really super important thing to do. And also as well, the final thing as well is obviously, particularly if you're new, do not withdraw your life savings and just send it over to the internet if you've never done it before. Don't do that. Do it in small increments. Yeah. I spoke to some people on the calls this week, on speaking to clients as well, and I said to several people as well, listen, just tone this down a little bit. Yeah. Because, but I want to make money. Yeah, but you're relatively new to it, and it's going to take you a while to learn it. Don't be that guy because any profits that you do make in those early days, they're largely as a result of being lucky. And that's not a good thing for a trader. We don't want to be lucky. We want to be learning, progressing, and working in the right way, and developing and becoming more skillful in our abilities. We don't want to be lucky, and if that one will always lead to a blow up. So just take it slow and use small amounts of money and open an account and test the water nice and gently, and then just keep it nice and small. That is the best way of getting involved in this. The markets are always here, and you can always ramp up later on, but take it nice and slow in those early stages. We have 3 brokers that we work with. They're good guys to work with. We work with Switch Markets. That's our main one now, because they offer an amazing deal where they will double your account balance. So if you deposit up to $5,000 with them, they'll actually match that. Now that's very powerful, because what it does is it means that you can have, it's almost like you halve your negative impact of leverage going against you, because they give you extra money to work with. Okay, you can't withdraw that money, obviously, yeah, but you can work with it on your account. And if you tone that down, that's a huge edge in the market. Couple that with positive swap rates as well over the long term. That's a really, really good deal. It's a really, really super good deal. So Switch Markets, they've been around a few years now. Really good bunch of guys. It's good. Yeah, it's good. They're going to be offering MT5 as well in the next 6 months or something like that. That's coming on board. They've got MT4 at the moment, and they're also very, very EA friendly. They're putting a lot of focus around EAs, so we have a lot of EAs on the website as well. They're good with that. Some people try and use the how to trade EAs on other brokers, and the broker will not allow them. Switch Markets is very, very good for EAs. You get a VPN as well, a VPS, sorry. That you can house the platform on. You can put any EAs that you want on there. It's a real open book for EAs. So there's a lot of really good advantages to do with Switch Markets that are worth considering. But the doubling your deposit is like, wow, I mean, it's amazing. The other ones are good as well. There's no, we're not favourites here. They're good as well. IC Markets are in Australia as well. They run a very tight book. They've been around a long time, and also Oanda in the States have been around such a long time since the mid 1990s. Really, they're one of the first retail brokers to transcribe, to actually grow up when the industry was opened up to the public. And they are one of the few regulated brokers, because the trading of CFDs is very difficult to do in the United States because of the SEC and the rules and the regulations from the CFTC. So Oanda are one of those approved brokers, so they are a good guy, and we partner with them. So they are almost as old as me, Nick. Yeah, that's right. Almost as old as me. I feel like I've been doing it a long time now, Liam. A long time. So they are a good one. So we only work with the good ones. So you can work with any of these people, and that also connects well with us as well. So if you are having problems, you not only can speak to these guys, you can speak to us, me, Shane, Connor, and any of the moderators here. We are fully tuned in to what's happening with these guys, and we can sort of help you out in all sorts of different ways as well. So just bear that in mind. But there's no hard sell. You want to work with Pepperstone? That's cool. They're good. Pepperstone, I've traded with Pepperstone before. I trade with AvaTrade at the moment. They're a good bunch of people as well. There's loads of them that are really, really good. So there's no hard sell in any of this. Tickmill, I've never traded with Tickmill. I'd like to trade with Tickmill at some point. I think they've got an interesting brokerage offering as well. So there's different ones out there that will all do different things. So yeah, like I said, there's no hard sell. It's whatever is best for you. But we do have a lot of connectivity with these guys as well, so we can help you out. Global Prime, Blueberry as well, FXCM, yeah, Liam's put them all in there as well. There's loads of them. And lots of people here will have traded with most of these people for years as well. So whatever you are doing in the brokerage area, if you've not yet opened one, there was someone here that can help you. And it really comes down to figuring out what it is you're trying to do. Get you in that base level with understanding where you are in the world, what it is you're trying to do, how much you're wanting to trade, what your trading style is, and then we can refine a deal for you that way. And there's always a deal to be done, so just bear in mind that as well. You're putting money with a broker, there's always a deal to be done. FXTM, I don't know. FXVM, I don't know actually. I've never heard of FXTM. No, I'm sorry, I don't know who they are. So that's pretty much it. So that's everything we've got. We've gone a lot much longer than I thought, nearly an hour. Sorry about that. Forex Time. Okay, fair enough. No, I've not come across them before. So yeah, that's everything we've got. So that's a good sweep round all the broker industry. Now this is on the past streams because there was a little technical problem before of it streaming on the website when I started to talk. So this is on the past streams. The full thing is on the past streams. And Sin, your question that you sent, I covered it in detail in the front end as well. So you want to just go back onto the past streams when we finish the stream now and just watch all of that about the explanation of how leverages and how it all works. So I've added that in for you. It's just there was a little technical glitch in it. It wasn't streaming on the website when I first started, so we only picked up halfway through. Okay, that's it. So Connor is out of the mix today and tomorrow. Bank of England will be coming up in a few hours' time. Not expecting any game changers there. I think it's going to be a relatively contained affair, although I am hoping that the pound will go up from here, but we will see. That's for sure. And then it's straight into non-farm payrolls for tomorrow, so I will start getting that all prepped so that everybody is in the loop for the 188,000 new jobs that we are expecting from the American economy being printed tomorrow. Okay, that's everything I've got for now. Enjoy the session ahead if you are trading, and I will catch you for the non-farm payrolls live on YouTube tomorrow.